guys, Akil Stokes here, Forex trader and head trading coach over at TradingPower.com, and thank you once again for joining me for another video. The other day in my live trading room, we had an excellent discussion on money management, and it really stemmed from the question of, hey Akil, how do your results differ from when you used to trade a single strategy versus how you trade now where it's more multiple strategies? And if you guys are new, I've had many evolutions in my trading career, many that I'm a little embarrassed to talk about. But essentially, once I made my final restart, right, that's what I call the moment when I finally went from bad to getting on the path to becoming consistently profitable. Once I made my final restart, I started off by focusing on a single strategy, right? I put all my effort, all my energy into a single strategy. And then as I've evolved as a trader, as I started consistently making profit with that strategy, and of course, continuing to educate myself on the market, I've added more and more techniques, more and more ways that I can attack the markets. And really, I haven't noticed that my profitability has been that different. I think the trader that asked the question assumed that, hey, if one strategy is this profitable, right, then multiple strategies should be this and this and this and this profitable. And I am becoming more profitable just because I'm becoming a better trader. I'm getting better at filtering out bad trading opportunities. But really, there hasn't been too much of a drastic difference. And that's because the different strategies that I trade attack different kinds of markets, right? You know, we have two main types of markets, right? We have trending markets when the market is going up or going down. And we have consolidating markets where they're going sideways. And I've got techniques that work well in consolidating markets and they work well in trending markets. And of course, vice versa. When the ones that work well in trending markets don't do too good when the market is consolidating. And the ones that work well in consolidating, well, they typically have a rough time in trending markets. But what I've done by adding these different strategies, adding these different tools, I guess, to attack the markets is not necessarily boost my return on investment from here all the way up to the moon, but it's really smoothed out my equity curve, right? Instead of being awesome during consolidating markets and then horrible during trending markets and surviving that until the next consolidation comes, right? It's a much smoother equity curve where I'm maybe not doing as good because one strategy is doing good during consolidating markets, but the other one's getting hit a little bit. But then the same thing with trending markets. That other strategy is doing really good during trending markets, but the consolidation strategy is kind of doing okay. What it's done is really smooth out my equity curve. And what I'm about to show you in the following clip is the power that comes with a smooth equity curve, right? And trust me, it's a massive benefit to really have small drawdowns. And well, just watch the clip and you'll see exactly what I mean. So here's why. This is why, because many of you guys are wondering, well, Akil, if you're, if the results haven't really changed, and this is a very good question, right? If the results haven't really changed, we're talking about me being just a pattern trader versus me being the trader I am now, where I trade a bunch of different styles. If the overall results haven't changed as far as your total return on investment, then why does it matter about having a smooth equity curve, right? Is anybody wondering that? Why is that a benefit? Right? Why does it matter how you get to the destination if you're getting to the same destination, right? If you take a choppy road to get to 40% versus if you take a very smooth journey to get to 40%, why does it matter? And the key comes in money management, right? This is the gem of trading, right? Your money management, guys. This is where you really make a difference. So we talk a lot about, I'm typically about between 30 and 40% trader return on investment per year before money management. When you add money management, that's what can easily add another 20% to your portfolio, right? And here's the key. If you have a choppy drawdown, if you have bigger max drawdowns, like I talked about in the first scenario, it's going to be harder to graduate to that next level of money management because each time you graduate and you up your position size, you're going to up your position size right into a losing streak. And what happens when you up your position size into a losing streak? Yeah, you lose more money. I actually went through a very weird phase in my trading where This was when I was winning like 70% of the time and I couldn't understand it. I went through a weird phase in my trading where I was very streaky. So I'd have like a monstrous month. I'd have like an awesome October, right? Where I'd bring in like 30% in October, right? Pattern trading was hot. And then what do I do in November, right? I double my position size because I'm hot, right? I'm hot. So instead of trading, a 4 unit, I'm trading an 8 unit. And then I trade an 8 unit right into a drawdown. And it's not even a big drawdown. It's a normal drawdown. But because I've doubled my position size, right? It's easier for me to lose money than it is for me to gain money. Does that make sense? Because I've doubled my position size, it's easier for me to lose money than to gain money. And then once I hit my losing streak, right, I've got to adjust my position size back down, right? Because my equity is lower. And now I've got to trade even better to get to where I originally was. And you see how that cycle destroys traders? That's what people don't see. I have to trade even better to get to where I originally was to begin with, right? So consistency is key for me in having a nice smooth equity curve, because if you have a nice smooth equity curve, you can do fun stuff like this. Now, I don't do this because I'm not super aggressive. I'm very conservative, but I want to show you guys kind of the coolness you can do. And you can't do this if you have big drawdowns. So you see this number down here, right? 118%, right? This is a fixed lot. This is no money management. This number over here, 118%, this is going to be with money management. Watch what I do if I take my delta and do a very conservative delta. Let's do 5,000. Watch that number. 1, 2, 3. 118% just turned to what? 165%. Conservative delta, right? Not bad? Would you guys agree? What if I did a little bit even more aggressive? Let's take it down to 3,000. Oh, look at that. 228. Not bad. Almost double. Let's take it down to, let's get fancy, 1,500. Oh, 433. Should we keep going? Should we keep going? Let's take it. Eventually, it's gonna hurt me. 1,000. Oh, 700%. Can we test it? Can we go one more? I think this is gonna break it. One more. Oh, 1,435%. Look at that. Now, did you see that, guys? I just took 118% return with no money management. And by putting in a money management system, disclaimer, I would never use this much. Trust me that this is insane, because this is your one big losing streak away. I mean, look at the drawdown here. This drawdown went from basically, looks like 144,000, right? Down to 85,000. I wouldn't want to do that in real life, but I'm showing you an example because my drawdowns are very consistent. Not consistent, well, they're consistent, but they're not very large, right? This type of move doesn't blow my account. It stinks really, really bad, but it doesn't blow my account. And then you can do fun stuff like change 118% return to a 1,400% return. Again, disclaimer, I wouldn't use 500. That's ridiculous, but given the example. Now, if you're someone that has massive drawdowns, if you're streaky, again, moves like this, these little drawdowns are probably going to blow your account. This right here is definitely going to blow your account, because you're typically entering those drawdowns right after you're moving position size from 9 to 13, right? And whatnot. Make sense? So that's when, people ask why I'm conservative, why I like a smooth equity curve. That's why. You don't see it in the trading, right? But the icing on top of the cupcake is the money management. We all know that. That's what makes your buck in trading. It's not how good of a trader you are. It is how good of a trader you are, but it's not by finding more opportunities. right? It's not by being more aggressive in the market. It's by being consistent and implementing a great money management system. That way you can do the same darn thing and whatever multiply your returns. So there's a little inside information for you guys. Transformation members, you guys know exactly about this. A little inside information for you guys that are new. Now, I've just wasted the first part of our session today. At 8:30, we're supposed to take our break for our Syndicate War Room meeting, which is where Jason Greystone comes in each morning at 8:30 and takes you on a delicious stroll around the markets, showing you what's on his radar. So I apologize for that, but we have slow markets today anyway. So now, before I leave you, I know you have this question. I can anticipate it coming. Akil, you mentioned earlier about having different strategies for consolidating markets versus trending market. Why not only use your consolidating strategy during the sideways markets and only use your trending strategy during the trending markets? That would be perfect, right? Makes perfect sense. However, in reality, so I'm not talking about hindsight and scrolling through charts. In reality, in real life trading, where you have that open white space on the right-hand side of your screen, we don't know that a market is in consolidation until it's in consolidation. We don't know that a market is trending until what? Until it's already trending. So if you're going to try and match your style to what the market is doing, you run the risk of being late. You run the risk of implementing your consolidation strategy when the market's on the very last legs of its consolidating period and starts to trend. And now you're out of luck because you got in too late, right? Now that we have a fully defined trend, right? We have that 3-point move in the trend and you're waiting to get on board. Now that we have that trend and you start implementing your trend following strategy, the trend has already ended, right? We've had our third drive and we're starting to go back into an accumulation phase or something like that. And now you're late to the party. So that could be a topic for an entirely different video, but it's not as simple for you guys that are new traders. It's not as simple as doing that. More so, you just want to be consistent with what you analyze and consistent in what you execute. So want to touch on that because I know it's coming. I know it's coming. So I appreciate you guys joining me for this video, and I'll see you next time. Take care. All right, traders, so I hope you enjoyed today's video, and if you did, please show us by hitting that like button and subscribing by clicking the button right below. If you're looking for more educational content, feel free to head over to our tradeempower.com website, or also take a look and you'll see more videos available for you. Have a good one.